India was hit by a very strong second COVID 19 wave in the June quarter of this year, and India Inc. was no exception. Although some might argue that less stringent lockdowns and a low base last year came to their rescue aiding performance in the first quarter of FY22. The performance was not uniform across sectors, as the impact of COVID 19 and inflation played out more for the likes of automobile companies, consumer staples, and durable players. On the other hand, cyclic sectors such as metals and oil and gas benefited. It would not be wrong to say that strong corporate earning did partake in driving markets to peak levels like 56,000 for the Sensex and 16,700 for the Nifty. But given the market's forward-looking nature, the question is, can earnings recover further? Let's do a deep dive.
So the earnings were largely in line with the expectation, with a few sectors showing strong resilience, wherein some failed to put a good show. So considering the second wave, the overall growth was expected to take a hit on the Q and Q basis, barring the IT pack, and which tagged the profitability lower. However, if you see the performance on Y-on-Y basis, we saw much improved numbers thanks to the lower base due to the strict lockdown last year. And the commentary given by the management too remained optimistic.
Cyclical sectors such as metals and oil and gas benefited from high commodity price realization, while raw material price inflation has impacted sectors such as auto, consumer staples, and consumer durables, as companies took price increases to pass on some of the raw material price increase. We saw earnings upgrade in the global commodity sectors such as metals, oil and gas, which was offset by the earnings downgrade in almost all domestic sectors, most notably in automobiles, banks, and telecoms.
See, the heavyweights like banking and IT surprised on the upside, with large bank posting stable asset qualities despite getting impacted by the second wave, and the IT sector, specifically the mid caps, continue to outperform with healthy revenues and order wins. But on the flip side, the auto results were slightly disappointing, as increased raw material prices and lower volume impacted profitability. And the pricing pressure in the key markets also led to the disappointing earning from the pharma space. If we talk about other sectors like metal, capital goods, oil and gas, consumer durables, they reported largely in line numbers. See, we believe the upcoming earnings season is expected to be better, largely driven by the demand recovery and the demand for the festive season. And at the same time, the vaccination drive, the ease of the restrictions by the state governments would further help, in reopening of the economy, and which in turn is expected to drive strong revenues. On the margin front, yes, higher input cost will continue to dent the performance, but many companies have already indicated that they are going to take price hikes and work on the cost efficiency measures, so which will help in offsetting the impact to a certain extent.
We expect inflation to be on the higher side, but not high enough for central banks to change their current accommodative stance. As economy gradually recovers, we believe the increase in demand will aid the top line and mitigate some of the risk from rising inflation. A key risk to our quarter expectations and earnings would be the impact of a third wave. With sentiments remaining buoyant and elevated activity in primary markets, Nifty valuations at 21 times 12-month forward EPS remain rich, and thus consistent delivery on earnings expectations going ahead become very important. Disappointment in terms of earnings expectations could prove to be a dampener for the bull rally. Also, if inflation continues longer than expected and higher than expected, then central banks will be forced out to roll out the exit strategies at a faster pace, and then the markets will have to adjust for a faster tapering.
See, the markets are pricing in sustained recovery in the earnings, and any disappointment can certainly dent the sentiment. So, and beside that, there are certain factors like macroeconomic scenario, the performance of the global market, valuations. They may also impact the rally in the long run.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.